The stock market in the long run is a pretty good inflation hedge, in large part because corporations, they basically earn a profit by buying things at whatever the rate of inflation is and then trying to mark them up. And so in the long run, something like the S&P 500 tends to be a pretty good inflation hedge.
Cullen, we'll continue almost where we left off on episode 370 in our masterclass about inflation. Inflation is still the talk of the town, and today it's no different. You're on record to have predicted the high inflation. And even though you also said that you've been surprised by the persistence of COVID and the war in Ukraine, like the rest of us, but you're now saying that inflation will moderate in the coming years. Why?
Yeah. Well, I think I've mentioned this, and I mentioned this in the masterclass. I think that the big important takeaway from COVID versus the financial crisis, it's such a nice comparison because a lot of the policies were very similar, but the main thing that we did differently was we ran these big fiscal deficits. And so that basically means the government spent a lot more than it taxed. And so the government essentially printed a lot of treasury bonds to finance its spending during COVID. And so, to put this into perspective, we did roughly $7 trillion of deficits over the 2-year period, basically over COVID, versus we ran about an $800 billion total deficit during the financial crisis. So we're talking about these programs were just monumentally different, and the size of the COVID response was so tremendous. And to me, that was always the big lesson from the financial crisis. I am sort of relatively well known for having been a sort of a disinflationist or deflationist coming out of the financial crisis, because I understood that from studying Japan and their bouts with deflation and implementing quantitative easing, that when you look at it from an operational level, quantitative easing is essentially just an asset swap. It's the central bank comes in after the treasury deficit spends, and then they exchange types of assets essentially. So the private sector ends up with losing a treasury bond and gaining a reserve deposit. And you can, from a monetary perspective, you can have this big sort of boring debate about what is money. And, is a treasury bond money-like? And in my view, a treasury bond is essentially like a savings account. And so the private sector from QE, it gets a savings account and loses a checking account. So people don't feel wealthier, even though from a very technical sort of economic perspective, the government has printed money, people would say, because people consider reserve deposits, obviously, to be more money-like than a treasury bond. And so in a traditional economic model, QE looks like it should be inflationary or even hyperinflationary when they're doing trillions and trillions of dollars of it. But from a really, I think, basic household perspective, all the household did was exchange the composition of its assets. And so, the Fed's response to COVID was very, very similar. They had this huge balance sheet ramp up. They cut rates. They did all the same sort of stuff that they did during the financial crisis. But the difference between the financial crisis and COVID was that the Treasury was the one that really ramped up their balance sheet and had this huge explosion. And so that's why I was much more worried about inflation coming out of COVID than I was with the financial crisis because of the Treasury's humongous response. And so I think the thing that, while I got the direction of inflation right, I think the tricky thing with all of this has obviously been the magnitude and the longer lasting effect of it. And I think a lot of that is just that, I didn't think I didn't think we'd still be talking about this thing at this point. Who could have predicted the Ukraine war, which, Russia basically shuts down one of the largest commodity producing countries in the whole world. So there's been all these sort of weird, impacts that have, I think, elongated the impact of inflation and made it a much trickier environment to navigate. And so, but to me, that's the big lesson coming out of this, is the Treasury and fiscal policy is really, really important. And that's really important to understand going forward because, again, let's put this in perspective. In 2021, as of the end of June, at this time last year, the Treasury had run a deficit of $1.7 trillion. These are huge, huge numbers again. Okay. So this is still, at this time last year, we're still in sort of the throes of really heavy duty fiscal stimulus responding to COVID. So far this year, through June of this year, the Treasury has run a deficit of $137 billion. Okay, so we're almost running, I mean, in terms of the way the US government usually spends and runs a deficit, this is almost a surplus, which is very, very unusual. So there has been, on a relative basis, there has been a huge fiscal tightening. So people talk about the Fed and how the Fed has raised interest rates, and a lot of that has caused this sort of like retrenchment in demand and tightening of the economy. And the thing that's lesser talked about is this huge decline in the relative size of the government's deficit. And that's, I think, when you combine these two things, raising interest rates is a very, very powerful mechanism, because it can, especially in a time like right now, it can cause a lot of turmoil in the housing market. We're starting to see that already. And if you adhere to the theory that the US economy basically is a housing economy, well, that's troublesome from a demand perspective. So high mortgage rates have snuffed out demand for mortgages, made it basically unaffordable for, they've locked out another 40 million people with the rate increases from the last few months. So huge, huge numbers. So demand is coming way back, and that has this huge knock-on effect through the whole economy, because, when you think about everything that goes into a house, think about the demand for how furniture now goes down, and refrigerators and appliances and all these other things that have a knock-on effect through housing. But then when you combine that with the fiscal retrenchment, there's been a big, big government tightening. So we had this big explosion in government spending and government stimulus in general. And now we're having a big, big give back. And so that, if the government had continued to do these big programs in perpetuity, that would have worried me. I would actually, I hesitate to say anything like hyperinflation, but a much more prolonged 1970 style rate of inflation, where you had double-digit inflation that lasted for basically 10 years, that's a much more plausible scenario under those circumstances. But right now, it's the opposite is happening. And so how fast will it come down? I mean, I think it's going to come down relatively slow, but I think that I think disinflation, meaning a falling rate of positive inflation, is going to become fairly well entrenched in the economy over the course of the next 18 to 24 months.
On your wonderful blog, trackcap.com, you said, and I quote, "There is no chance of hyperinflation. I would argue that the risk of deflation is substantially higher at this point than the risk of hyperinflation," end quote. Could I please ask you to elaborate on that?
Yeah, so I think, kind of going back to that, the forward-looking, expectation of a recent trend in the fiscal retrenchment and the Fed's big, attempt to really snuff out inflation, I think that the risk of deflation now becomes greater, because I think that these are both very, very outlier events. So we're talking about, pretty unusual things to begin with, but the risk of a sort of mini 2008 repeat, where, let's say, housing prices, I expect housing prices to fall 5 to 10% over the course of the next 18 months. That's kind of my base case. So housing is going to be relatively weak, I think, over the course of the next year at a minimum. There is a chance that I'm wrong about that the Fed response is much bigger than we expect, that they're much more aggressive and much more prolonged with it than we expect, and that housing falls more than I expect. I mean, housing boomed so much during the pre-COVID period and then the COVID period that you could easily get a 20%, retracement in house prices. Wouldn't surprise me at all if something like that happened. That would have a very big negative impact on the economy. I think that if that happened, you would, by the time that plays out, let's say it's 2024 and housing prices have fallen 20% from their peak, I think at that point there's a very good chance that CPI readings and the Fed's preferred measure, core PCE, personal consumption expenditures, is negative at that point. And that's just going to be a function of demand just falling off of a cliff, and this, huge knock-on effect from the negative housing market. So to me, that's a much, much more likely scenario than a hyperinflation, because in large part, because if you've read my research in past years, you know that hyperinflation generally occurs under very, very unusual specific scenarios, usually scenarios such as, like very corrupt regimes, a government losing a war, a complete regime change in the government, these sort of really like seismic events that are very disruptive at a government level. And the government usually responds to that by then printing huge amounts of money. And so, we've technically printed a lot of money in the last 2-3 years. You haven't had this big sort of disruptive, geopolitical event at a government level that I think has caused a complete collapse in faith in the currency. And in fact, I would argue that if anything, what we've seen in the last especially the last 12 months is, if anything, we've seen increasing demand for the dollar in a relative sense. And so, to me, it's very hard to envision, if we were having this discussion and we were sitting in, Nigeria or something, it would be a totally different discussion. But when you're talking about the world's reserve currency, you're still talking about on a relative basis, and even if you believe all fiat currencies are trash, the US dollar is the least trashy of the trashy currencies. So it's very hard for me to envision a scenario where you get this huge collapse in demand for the currency, in large part just because the U.S. economy's important role in the global economy, and combine that with just the fact that you don't have the environment for this sort of seismic shift in faith in the currency.
So let's talk a bit more about deflationary pressures. One of the major macro trends has been globalization. For example, not pushing wages up in the US that otherwise would have been the case if Americans had not imported the same amount of goods from countries with cheaper labor. Another is really the whole thing about how does demographics work. With the demographic trends you're seeing right now in the States, perhaps we can start with the States. Do you see them as inflationary or as deflationary?
The long-term trends in demographics around really the whole world are pretty alarmingly worrisome for economic growth. And it's one reason why, it's interesting. We went through this. I think that the last sort of 100 years they were sort of unusual. When you look at economic trends, the really long-term economic trends, 1% to 2% growth was pretty normal. That was kind of the status quo. And we had this really unusual period where, especially in a lot of the developed world, the populations boomed. And so you had, obviously like the baby boom and things like that, where at a very basic economic level, more people means more demand. It means more output, more things are going to be created. And so, from a crude sort of economic level, you can argue that, future economic growth is essentially, well, we can be more productive or we can produce more people, which will produce more demand, which will produce more stuff. And that's sort of a crude economic model, but it's generally, in the long run, that's generally how economic growth works. And so seeing these declines and even slowdowns in demographics is worrisome, just because it's foreshadowing of lower growth. And I think, again, Japan has really been the playbook for all of this stuff, whether you even look at like QE and fiscal policy, or if you look at their demographic trends and what's been going on there and the very low rate of economic growth there. And I think that that's already playing out across the entire developed economic system. And it's hard to see that changing, especially, in the US, we're seeing this sort of reversal of some of the hyper globalization trends, where the US is becoming a little bit more of a closed economy, a little more abrasive towards immigration and some of the things that have really benefited the United States in terms of, you can essentially argue that immigration is like stealing other people from another country and benefiting in economic terms, because you've got this multiplier in terms of people. And that's especially true in the United States, where we haven't just grown by having, positive immigration trends. We've grown in large part because we've benefited from a very high quality immigration. Our education system has attracted a lot of people that have built enormous valuable companies here and goods and services. So there's been an even bigger multiplier effect through that effect in the United States. And a lot of that's reversing now. And so it's a little bit worrisome to see the decline in demographics because it's foreshadowing of lower growth. And so it's one of these big secular trends that I think in the long run makes it hard to foresee really, even moderately, high inflation, something like, or a return to the 1970s. Because again, going back to the 70s, a lot of that was a population boom. People don't talk about how the 70s were still, the back end of some of the most productive years of the baby boomers. And so you had this huge demand boom at a time when you had supply shocks and things like that. And you're not going to have those trends going forward because we just don't have the population growth that we did back then. So yeah, it's worrisome. But when you combine that with things like technology growth and the coming fiscal retrenchment and things like that, it's hard for me to imagine that some of those big secular headwinds won't be things that are kind of anchoring inflation to some degree.
And let's continue to dive even deeper into inflation and deflation. Could you please explain the concept of velocity of money and whether that's an important concept to understand inflation?
This is a tricky one. So in the traditional old monetarist methodologies, you would argue that, something like MV equals PY, which is basically that money times velocity equals price times growth, basically. And it's a crude sort of model. And I'll explain why. It's because you can back out velocity based on what your definition of money is. So when you look at the front end of that equation, M times V, well, the tricky part about that is you have to define M. Okay. So if you assume that M, for instance, is bank reserves, well, when you run your model based on that and you look at MV equals PY, well, what does that mean for inflation and economic growth? Well, you assume that it means that demand will increase. Okay. So quantitative easing technically is an increase in M. Okay, under a traditional sort of monetarist model. Well, that should increase P in the long run, assuming that you don't get a big surge in V. But when you reverse that, you go through the math on it. Well, if P doesn't increase, then V has to have declined. Okay, so you can kind of back into this model where when you look at, this has been a common excuse for why QE didn't cause inflation. People will argue, well, V just went down. Well, of course V went down because P didn't go up. But the problem with that is that when you look at quantitative easing, well, the problem there is that your definition of M was wrong the whole time, or at least your definition of M was, I think, very, very loose to a point where, because you didn't understand the difference between treasury bonds and reserves, well, like I said before, quantitative easing was just this asset swap. And so technically we increased the quantity of M, but if you included treasury bonds in the definition of M, well, from a private sector perspective, all that happened was the amount of M was swapped. The Fed created more reserve M and eliminated from the private sector treasury bond M. And so there was this clean asset swap. And so the velocity of money went down in part because you could argue that was quantitative easing, for instance, coming out of the financial crisis, was it deflationary? Meaning that basically what the government did was they reduced the value of the M that they created because they reduced the amount of interest they were paying. And that's what quantitative easing does. And so there's this interesting sort of theoretical debate about, was quantitative easing inflationary or was it deflationary? And I'm not really sure. I mean, there's all sorts of like knock-on effects from quantitative easing and interest rate impacts and things like that. And I don't have like a strong definitive view, but I suspect that quantitative easing is far less powerful than people generally suspect. And so, getting back to the question, with the velocity of money, it's this very tricky thing to really articulate because you have to have an accurate definition of M. And I prefer to use, I don't think you can use a black and white definition of what M is. I think that in my view, money is something that exists really on a scale. Like I argue that stocks have a certain degree of moneyness. And this concept of moneyness is important because treasury bonds, while they may not be strictly money, they have a certain degree of moneyness. And so, when you think of things in this sort of scale rather than a black and white, model, the world gets a lot more difficult to put into sort of this strict mathematical model like the velocity of money likes to sort of define. And so to me, I don't find money velocity to be a very useful metric just because I don't think you can strictly define what M is in this sort of mathematical sort of sense.
Colin, every week, The Economist publishes economic and financial indicators for the 43 biggest economies in the world. There are only 3 countries that have a positive budget balance. And it's more the exception than the rule that it's negative. And perhaps I could just point out the irony that of those 3 countries, it's Denmark, Norway, and Saudi Arabia. 2 of them are socialists. So it's just sort of interesting in itself. But anyways, if you don't know what the budget balance is, it's the balance between total public expenditures and revenue in a specific year. So if we look at the US, minus 5.9% of GDP, Euro area minus 4.4%, and even communist China, that's minus 6.2. So it's across the board. Does spending more money than you bring in create inflation?
Well, yeah, I think, again, like I was saying earlier, that to me is one of the big lessons of COVID is that when governments run big deficits, you have the risk of rising demand. And especially when you don't produce the aggregate supply to meet that aggregate demand, you get a price increase. And so, yeah, that's one of the important lessons coming out of COVID. I think, this gets into a really sort of interesting theoretical debate of, in the long run, it makes sense that balance sheets, I mean, in a fiat monetary system, balance sheets basically need to always expand. My deficit is somebody else's surplus. In order for you to be able to save, you essentially have to rely on somebody else running a deficit to be able to create the financial assets to allow you to be able to save. And that can come from It could come from the government. It could come from me. It could come from the corporate sector. It could come from the rest of the world sector. So, that this balance sheet expansion doesn't have to come from the government, but it has to come from somebody in the long run. And that's, I think, an important thing to understand about how any credit-based system, even a Bitcoin-based system, is turning into a credit-based system in the long run and will rely on this basic, accounting that you need somebody to be expanding their balance sheet in order to allow somebody else to save in the long run. And so you can get into this really interesting theoretical debate, though, about whether or not does that deficit have to come from the government sector, and I don't know, honestly. I tend to, I wrote a book called The Pragmatic Capitalist. So like I'm obviously, amenable to capitalism more so than socialism, and I'm pretty skeptical of the idea that the government can do things as well as the private sector in general. I think that when it comes to government spending, I think that the government generally should do things that the private sector simply cannot or will not do. So, for instance, like operating a military is the perfect thing for a government to be doing because the private sector doesn't want to do that, can't make money from doing it. It's pretty hard to make money when you rely on killing your workforce and blowing things up. That's not a very profitable business endeavor. So, things like that have a sort of a negative net present value, those are perfect things for the government to do. And socially, we benefit from those things because obviously, like if you have to go to war, that's something that needs to be done. And it doesn't, you kind of accept the reality that like, oh, during wartime, like maybe, making money isn't the most important thing in the long run. And so that's all well and good. But you get into this debate about, should the government then try to do things that have a positive net present value? Like that's essentially the role of the private sector, is that all of us in the private sector, we're trying to add value and run operations that are essentially adding, present value to people in the future. And we do that by trying to run, businesses or at a household level, trying to generate a net income, basically. And so the things that we do, they have to add value to other people. Whereas the government, in a lot of ways, the government can just do things that are socially good to some degree that, maybe they don't have a positive net present value at the aggregate level. Maybe they're more charitable in terms of the way that they're being done. And so, you get into this big debate of whether or not, operating an economy to just run profits is in the best interest in the long run versus, should we do things that are more charitable in nature, that sort of, take care of the social well-being of the country. And I think, for the most part, I think that the developed world and the United States has done a pretty good job managing that balance of government spending versus having a big, mainly, capitalist sort of private sector run economy with a pretty large government sector attached to it, but a government sector that for the most part does a lot of funding of financing and things in the private sector, but for the most part doesn't do, a lot of sort of crazy large negative net present value projects like you see in places like, for instance, I'd argue that a lot of the, Latin America is like the perfect example of how not to run this balance of private sector versus public sector. And the United States, for the most part, has done a pretty good job. You could argue that the last few years were really tricky in terms of navigating COVID and that we did a lot more than we should have, obviously, in retrospect. But for the most part, it's a tricky debate. I tend to lean towards the view that the government should sort of sit back and do these negative net present value projects, put out fires, run the military, and then, manage the court system and kind of back off. And then let the private sector do the heavy lifting in terms of competing and trying to do these things that will generate value mainly through the competitive forces of capitalism. But it's tricky. The honest answer is nobody really knows what the right balance is. And I think that's why people have these really contentious debates about politics, because we don't really know what the right level of government is. But, getting back to the original question, running a budget balance that's a negative budget balance in the long run is not necessarily bad. And I think running at least having a government that runs a negative budget balance to some degree, even while it might be inflationary, it could still be perfectly consistent with generating social good in the long run. So I hesitate to say that, running deficits is inherently bad. Even though, obviously we know now from COVID, for instance, running really, really large negative deficits it can have a hugely inflationary impact. And so it's this balancing act where in the long run, I think, you want a government that's regulating the economy and to some degree, and you want a government that is, operating a military and doing these things that the private sector doesn't want to do, but nobody really knows the exact right balance.
Yeah, and I think you bring up such a good point because it's also so value driven. Like, what is it that you want? And based on what you want and what your values are, you can come up with this is how much the government should be included or not be included, or should you even run a deficit in the first place?
It's so subjective. You get into this
sort of subjective.
It's so subjective. You get into this debate about living standards and it's one thing that I've always said and written about a lot on my website, that living standards in the United States have boomed in the last, 100 years. You could argue that people today live better than at any point in human history. And which is weird to think about when you look at things like, if you look at metrics like government debt or, the value of the US dollar, you see this all the time. I talk about it a lot. The value of the US dollar technically has declined in purchasing power terms by 95% over the course of the last 100 years. But living standards have boomed. And so it's this weird, very subjective debate where, yeah, at a basic sort of economic level, you have a decline in purchasing power, but living standards have actually increased substantially. And that's in large part because we've produced a huge amount of real goods and services that have made life just better in general. But it's all so highly subjective, and different countries obviously value different stuff. And, Europeans value very different things than Americans do. And so, yeah, it's, people like different stuff, and it becomes this very subjective, argumentative debate about, value judgments.
Yeah, and I think you bring up such a good point. And what we can say across the board is that most countries like to have a deficit, but then, we can probably take it back to that's democracy. One of the ways to win an election is to promise a bunch of stuff and have someone else pay for it. And regardless if it's, lower taxes, if that's how we want to finance it, or, just spending more money one way or the other, like, it's usually always negative, and then someone in the future is going to pay for it. And so, yeah, to your point, it's really subjective. Let me ask you another question I've really been looking forward to, and it's really going from the it was a lot more political charged, I guess, what I said before with my previous questions that I recently intended. But let me take you from the frying pan into the fire. This the next question here is tricky because many of our listeners are already thinking about retirement, and inflation is really hard to pin down. Whenever you consider your portfolio and your financial needs when you retire, you're looking at hopefully decades to come. How do you include your inflation expectations in your asset allocation for retirees who have to live off the portfolios?
This is a hard question. I've advocated increasingly, in recent years, I've become a big advocate of all-weather portfolios. And I've always loved that concept of sort of having an allocation that protects you no matter what the scenario is, whether it's, the classic, for people who aren't familiar, the classic sort of all-weather portfolio was Harry Brown's 4-quadrant all-weather, which basically was deflation, inflation, recession, and expansion. And basically his sort of really simple model for that was that you wanted to own gold for inflation, you wanted to own stocks for growth, you wanted to own treasury bonds for deflation, and you wanted to own cash for recessions. And so you had this very simple 25% 4-quadrant breakdown of the portfolio that the theory was that this would protect you from all environments. And I've always been, the thing that has always sort of, I think, made me reluctant about adopting that sort of a model, really embracing it aggressively, is the holding of 25% gold and 25% cash. Just always from a basic portfolio theory perspective struck me as that's too much in both. And, who knows what's going to happen with, if for some reason, like the demand for gold was replaced by the demand for Bitcoin, let's say, for instance, in the next 100 years, well, your inflation component there might not do anything. And so we've kind of seen that in the last few years. For instance, gold hasn't done as well considering the inflation that people might have expected. And actually a broader basket of just commodities has done much better. And so, for me, from a financial planning perspective, I think you have to take inflation and this, the asymmetric risk of it into consideration. And for most people, I always say the stock market in the long run is a pretty good inflation hedge, in large part because corporations, they basically earn a profit by buying things at whatever the rate of inflation is and then trying to mark them up. And so in the long run, something like the S&P 500 tends to be a pretty good inflation hedge. You see years like 2022, though, where, you can go through periods where the stock market goes down. And in real terms, the stock market is down, 25, 30% this year. And And so you can get periods where the stock market volatility doesn't protect you in the short term. And that's where a lot of this gets tricky. And for most people, I always tend to, from a sort of financial planning perspective, I think you have to look at this holistically. So for instance, like, do you own a home? I mean, I think housing in the long run tends to be, or really owning real stuff tends to be a pretty good inflation hedge in the long run. I mean, real goods and services tend to be, and you could argue that stocks are to some degree just real assets. Real assets in the long run are always good inflation hedges, but you can have these acute periods like this year or the last, sort of 12 months where things like commodities are much better inflation hedges. And for me, it's interesting timing bringing this up because I'm about to publish a new paper. It's the first paper I've written in years. It's called All Duration Investing. And my perspective on this basically is I'm trying to apply a concept that is similar to all weather, but I'm doing it in very specific time horizons. And so what I've done is I've actually calculated the duration of all asset classes across the board. I've calculated the duration of commodities, of equities. And what I mean by that is I'm using essentially a model where I'm assuming a point of indifference. And so to me, the point of indifference for an investor, when you think of fixed income, the traditional metric of duration is how indifferent is an investor in fixed income or bonds to losses, basically. So what will an increase in interest rates cause in terms of principal losses? And when you think of that as like a point of indifference, well, in the long run, a fixed income investor becomes indifferent to losses at some point because they're earning a higher interest rate. And at some point in the future, the higher interest rate pays off. And so you can do this across all instruments where you look at, for instance, if the stock market were to fall by 50%, well, future expected returns should increase typically in the long run. When asset prices decline, typically the value of that asset becomes actually, it's kind of, counterintuitive. But when asset prices fall, typically the future expected return of that asset should increase. At some point in the future, you become indifferent to the loss in that asset class. And so in my model, for instance, a stock market investor is indifferent to losses on average over about an 18-year period. And so what I've done is calculated these durations for all asset classes and then plugged this into a model across time. And to me, that's the key aspect of good financial planning, is that you want to look at things in certain buckets, essentially, where, for instance, you need some cash in the short run to manage your, say, whether it's emergency funds or your monthly liabilities. But that's the way the financial system works, is that the financial system is structured, and our financial lives are structured across these very specific time horizons. And so you want buckets for short time horizons and medium time horizons. And let's say, maybe you want to put a down payment on a home in the next 5 years, but you're not really sure where. Well, that money shouldn't be allocated to the stock market, because the stock market, in my model, is this 18-year instrument. So if you need that money in the next 5 years, for instance, well, the stock market's not a good place to put that. It needs to go into an instrument that has an appropriate duration relative to that. And so something like cash or even an aggregate bond fund would fit that model inside of a 5-year time frame. And commodities and inflation hedges, the way that I calculated this, it's interesting. They're basically like 30+ year instruments, but they have a highly short-term asymmetric payoff. So what I mean by that is that gold and commodities, they almost operate, I shouldn't say almost, they operate like inflation insurance in a portfolio. So for instance, what is insurance in a financial planning aspect of a portfolio? Well, if you buy a 20-year term life insurance policy, you've bought a long duration asset that has a highly asymmetric short-term payoff. So if I buy a term life insurance policy that has a 20-year term, and let's say I croak in 2 years, well, that instrument, although it had a 20-year duration, that instrument had a huge, real positive asymmetric payoff in a 2-year period. So you can think of, I like to think of commodities and gold and inflation hedges in much the same way, where they have the potential to provide you with this almost like insurance-like policy payoff in a short time horizon, even though they're really long-term instruments. And so, it's hard to describe this without having the paper in front of me, but if you think of this stuff sort of on a bell curve, I think it's useful to think of like building out your asset allocation in terms of like across these durations, where the stock and bond market make up the core sort of central aspect of the bell curve. And then on the edges, you have things that have these sort of important real and nominal asymmetric payoffs, where cash, for instance, it's going to lose in real terms every single year, but it provides you with absolute nominal certainty. And so on this left tail of the bell curve, you've got this absolute certainty in nominal terms. And on the right tail of the curve, you've got insurance type instruments. So gold, commodities, you could throw Bitcoin into there, things like that. Life insurance fits into that for sure. Things that have this sort of, really, they're long duration instruments that have a potentially large asymmetric payoff. And you can, depending on how, personalized you need this all to be, me personally, I tend to, you got to start with the stock bond core, and then you can build out all of your, sort of tangential instruments on the side. But I think in the long run, this fits into sort of an all-weather approach, in the sense that you can build out this model and this asset allocation approach where you're taking sort of what I call this all duration approach, where you own things like commodities and gold, but they're there in a very specific allocation where, let's say it's like 15% of your portfolio in total, where it's a relatively small portion, but it provides you with asymmetric certainty in environments like the one we're going through.
Yeah, it's such a tricky topic. I mean, you're trying to forecast something for decades, and you're doing that with instruments or assets that you don't know what's going to yield. I mean, it's really tricky, and we depend on it. That's what makes it even more scary. Colin, in December 1989, the Parliament in New Zealand decided on a 2% inflation target for the central bank, and this is perhaps more significant than it sounds like to our listeners, because this was the first formal target to be adopted by a central bank. And since then, many have adopted a similar 2% target, including the Fed and the ECB. And you can also argue that the lower the inflation target, the more unemployment the Fed would have to create to get there. Now, let's get to the perhaps more controversial part of it. Remember that the Fed has this dual mandate of price stability and maximum employment, which seems to be counterintuitive. Of course, no one likes unemployment. And since there is a perceived little difference between a 2 and a 3% inflation, should the central bank then increase the target?
This is a really, really interesting question. What is the right amount of inflation in the economy? And should the government even have a positive inflation target? It's interesting. I think when you look back through history, I think the part of the reason that they arrived at this sort of 2% target is because 2%, this sort of low rate of inflation, 1-2%, something like that, it's still consistent with rising living standards and historical data. And so, from a basic financial system perspective, like I was saying before, you're always going to you need balance sheet expansion. You need somebody has to be borrowing and creating financial assets in order for the rest of us to save. And it's just a natural byproduct of, population growth and increased productivity, is that you're going to have more borrowing, more people. Money isn't always equally distributed. And so, when somebody wants to buy a new home, they may not be able to find existing money. They may not have the money in their pocket right now to be able to buy that home and build it. And so, some level of borrowing is totally natural in a credit-based monetary system. The question is, does that credit growth have to coincide with inflation? And I think that's a much, much trickier discussion. I think that if you had an economic system where the private sector was the only borrower, where all money creation essentially was valued based on how productive it ultimately was, I think you would experience lower rates of inflation than we've seen. The interesting thing with having a system like that, where when you have if you had a purely private based financial system, well, you'd probably have higher degrees of things like inequality, which then creates an argument for more government, which you get more government, then you get more inflation. You get more of that negative net present value spending potentially, to try to equalize things. And so you get into this messy debate about what is the right size of government really. And to me, I mean, personally, I don't think there's not like a need in a monetary system to have a positive rate of inflation. To me, it's just the positive rate of inflation is, to a large degree, it's a byproduct of having a primarily capitalist based system that is predominantly private sector run, that also happens to have a fairly large government attached to it. And I think you can make an argument that 1% to 2% inflation per year is it's the cost of having things like a public sector run court system and regulatory systems. And, these things aren't free. And so to the extent that we borrow or that they just don't have a net, present value sense, they don't have a positive net present value in terms of like a profit sense. These things can result in some marginal inflation, I think, that, is that necessarily bad in the long run? Well, history would tell us that, averaging 1% to 2% inflation is not necessarily consistent with declining living standards. So, I don't know. I don't know the right answer. I would like to think that you don't need to have inflation in a monetary system, but I think that, it's hard managing that right balance of public sector versus private sector. And obviously, you don't want really high inflation, but there doesn't seem to be an inconsistency between a low level of inflation and rising living standards in the long run. So, maybe having a court system and a military and things like that, maybe those are just the inflationary cost of having a government in the long run. And you can get into the debate about how much bigger the government should be than that. And I think that's a useful debate to have. But in general, I guess my answer is I don't really know. I don't know what exactly is the right rate of inflation, but we certainly know that anything over 2% or so seems to be problematic. At a minimum, it's consistent with social upheaval and bigger societal problems that do cause meaningful declines in living standards. So I think we can all agree that nobody wants a high level of inflation, but whether or not we want 0% inflation or 1% or 2%, I think is a much more reasonable debate.
It's a very difficult thing whenever it comes to inflation. I know I've been asking you really, really tough questions, so I'm really, really happy that you're up for the task here, Cullen, because as much as we could say today, well, we should probably have, say, 3%, because then we don't need to bring in as much unemployment. Everyone likes high employment. Well, it's a slippery slope. We also have seen that before. If we tend to think that inflation is coming and like it becomes self-reinforcing, does that mean that in the next crisis we'll say it's okay with a 4% or 5%, and then what happens in the next crisis following that? So it's really tricky, and it's, as much as the 2% is arbitrary and the Fed is on record saying that it's arbitrary, it's definitely on purpose that it's in that level, and it's positive and it's not deflation.
No, I was just going to say, historically speaking, it's one of the things MMT has been really popular in the last few years in terms of like the social discussion, and like what their big policy discussion is that the government should run a job guarantee. And I've always been sort of skeptical of this idea because the basic thinking there is that you can give everybody a job. So the government guarantees everybody a job, and they argue that there would be price stability. This has never been done before. And so that's where you get into this very, theoretical debate about, is it even possible to have a society where everybody has a job, everybody is guaranteed a job, and you have low inflation? I don't know. I'd like to think that is certainly possible. It'd be great if everybody was employed and doing something productive and happy, and we also just happen to have low rates of inflation. I'm pretty skeptical of whether or not that's possible. It's certainly never been done. And so, but you can also have the opposite, where, you have, societies and economic periods where, unemployment is super high. And obviously the trade-off for that is that sometimes the rate of inflation is really low as a byproduct of that, because demand is so low. And is that, the Fed does not have an enviable job trying to manage a dual mandate of inflation and unemployment.
No. And, I share your skepticism of MMT. I've tried getting someone of the proponents on. To me, it makes very, very little sense, which is probably also why I'm want to talk about it, because it's like, it's, to some people it just seems like the most obvious thing, and to me it just makes no sense. And anyways, let me before I go into this rabbit hole of MMT, let's continue on this thought experiment. So let's say that we will go into a prolonged period of not only deflation, but, for example, 2 decades of deflation. And I just wanted to clarify, whenever we talk about deflation, we were talking about a slower pace, typically within a somewhat shorter time period. So let's say that we would go from a 9% inflation to like a 6% or 4%, whatever. So we're in a disinflationary, you could say deflationary, but in this context it's technically called disinflation. Whereas if you have deflation, you would have decreasing prices across the board.
Mm-hmm.
But let's say that we had 2 decades of deflation. How would consumers and investors need to react to that?
This is sort of the Japan scenario. It's one thing, man, one of the most interesting charts I've ever seen is Japanese real estate in the last 20 to 30 years. I mean, we're so used to, in the developed world, real estate prices just always going up pretty much. That was a part of what everyone kind of knows. Like, that was part of what caused the financial crisis to be so bad, was that in the economic models, all these investment banks assumed that real estate prices just either wouldn't go down or wouldn't go down very much. And so when real estate prices went down 20, 30%, that obviously that caused it threw a wrench in everything. And in Japan, though, real estate prices have been going down for 20, 30 years, which is sort of unfathomable in the United States. But it's something that, that sort of a scenario, I mean, it keeps me up at night, to be honest, because the real estate market is such an impactful instrument in the entire US economy. You'd have very, very low rates of growth. I mean, in that sort of a scenario, if that's something that you expected, or if you thought it was a risk, you'd want to own, counterintuitively, you'd want to own a ton of bonds. So bonds in Japan were the thing that hedged people from, people talk about how the Japanese equity market has been down over this, this sort of, lost decade or whatever. Well, the thing that people don't always point out is that if you owned a 60-40 portfolio denominated in yen, where you owned the Nikkei, for instance, and Japanese government bonds, well, you actually did okay, because the government bonds performed so well that your relative performance was okay. So diversification actually worked out okay in Japan because of the bond component. But the same sort of scenario would play out in the United States, where people are worried about inflation now, and they're worried that, oh, bonds are dead. But if we got prolonged, entrenched deflation, the bonds are the things that would perform really well in that, in terms of an asset allocation. So, again, kind of going back to that sort of all duration or all weather sort of perspective, it's why I always advocate. I always tell people, you always need to hold some cash and short-term bonds and even some intermediate, potentially long-term bonds. Treasury bonds are, they're sort of that deflation insurance like product, super long duration instrument. But yeah, in terms of like an economic outcome, it's hard for me to imagine that wouldn't be sort of a disastrous scenario, that it wouldn't be coinciding with something, much more negative in terms of what's occurring, just because in order to get this sort of 20-year period of entrenched in deflation, you'd have to have not just negative, probably demographic growth. You'd have to have declines in productivity and really, almost like 0% GDP probably for decades, which would not be, obviously would not be great. So is that going to happen? I personally, I think that's a low probability, just because the demographic trends, even as bad as they are, in the United States and some of the developed world, they're not necessarily going to be negative. And I think productivity will continue to be relatively strong. And it's hard for me. The United States is still such a real estate based economy that when you look at it in the long run, I mean, God, looking at it from like a supply perspective, like one of the problems in housing is there's a huge shortage of housing. And so in the long run, are we going to stop building homes in the United States? Using a sort of crude housing is the economy sort of model. It's hard for me to imagine that even with the ebbs and flows in the long run, there is a lot of building to be done in the United States in terms of building out the real estate market.
Amen to that. So let me come up with another extreme thought here. I can't help myself, Colin, now that I speak with you, and I know the way you think about money and like to think about, things from a different angle. I have a question about a Fed call. And so what do I mean by that? Well, let's first start with the Fed put. That dates back to the era of Alan Greenspan, former chair of the Fed. And starting with the stock crash back in 1987, the Fed cut rates whenever share prices plunged. If you are an investor, it resembles the benefit of a put option where your downside is getting cut. And some argue that we are now heading for a time with a Fed call, which is exactly the opposite, meaning that you're capping the investor's upside. And we know from studies, the wealth effect, that the wealthier people feel that they are from the stock holdings, the more they spend. One study from Howard University shows a 3-cent of increased spending on each dollar of increased stock wealth. And then, of course, you can add the added benefits of employment, wages, and so on. And all of this adds to inflation, which currently seems to counter the main objective of the Fed, who has this dual mandate, as you might remember from previous in our conversation. So the $1 million question, are we now heading into a period of the Fed call?
It's crazy. They've sort of said that. I mean, in the last 6 months, they've made it pretty clear that they think asset prices are too high. They want to create this sort of reverse wealth effect where they sort of, I should back up a little bit. I think that, kind of going back to what I was talking about earlier, there's a lot of different transmission mechanisms for monetary policy. And to me, interest rates are a very powerful policy lever. I do not think, people tend to think, when people talk about, like the Fed put, they often talk about quantitative easing and like the balance sheet expansion. And I don't think quantitative easing is as powerful as a lot of other people tend to think. And I think that, drawing these correlations between like the Fed's balance sheet and the stock market, to me, is just sort of silly. Like the Bank of Japan increased their balance sheet for decades, and the Nikkei, had a marginal correlation to these changes. So, there's scenarios where the ECB also, like, the European stock markets performed on a relative basis horribly compared to the US stock market, and the ECB was ramping up their balance sheet. So what was it seems like there's very mixed evidence on whether or not the balance sheet expansion really is that the Fed put. To me, the Fed put and or what we're seeing now, sort of the Fed call, is really the interest rate impact, and the way that the Fed can very precisely, or I shouldn't say precisely, I should say the Fed can very, almost like using a hammer, can sort of bludgeon the economy with interest rate changes. And that's a lot of what we've seen in the last 6 months, is this repricing of assets because interest rates have changed so dramatically. And that's a very, very blunt instrument, but it's a very, very impactful instrument, especially when it's used in a very aggressive way, which is what the Fed's been doing. And so, yeah, they've made it very clear. I think that they've, have they overreached? I think at this point, that's the bigger question. I think that's the question that the stock market and the broader economy is now grappling with, is has the Fed implemented this call in a short-term period where they've raised rates so fast that they've sort of bludgeoned the real estate market, basically? Have they snuffed out demand for real estate to an extent that, yeah, it'll fix inflation because it's going to fix the demand side of everything, but have they overreached? Are they now going to find themselves going into 2023 having to backtrack a little bit because they caused some unemployment? And that's where you get into that that dual mandate balance, and what a tricky balancing act it is, because now it's crazy. The Fed forecast of Fed funds futures, they actually forecast falling rates in 2023. So the Fed has sort of, put themselves in this position where, yeah, they've raised rates very aggressively. It looks like hopefully they're going to get inflation under control, but are they going to do so by driving the economy into sort of this prolonged or deep state of either negative or zero growth, where you get a jump in the unemployment rate that causes them to then have to implement, the Fed put again, to cause a reversal in a lot of these trends? Personally, I don't think the Fed can afford to continue to implement this so-called Fed call in the long run in an aggressive sense, that they won't continue to raise rates really aggressively, because I think they'll cause too much damage to the housing market. So kind of going back to the beginning of our discussion, that risk of deflation to me is higher than the risk of inflation or prolonged high inflation going forward, in large part because of the Fed's policy response. I think they overreached a little bit. The mortgage market has started to adjust some already. We've seen interest rates retrench a little bit in the last month. And I'd be shocked if they continue to really put the pedal to the metal, because I think there's a really meaningful risk now that the housing market is slowing, and that it's slowing at an uncomfortable pace that could result in, we're having this big debate in the United States over whether there's a recession, and it's kind of a silly debate, whether 2 quarters of negative growth. I wouldn't be shocked if we end up having 4 quarters of either low or negative growth in a row. Is that going to be technically a recession? I don't know, but it's not good. I think we can all agree on that. 4 quarters of 0% GDP or whatever, or negative GDP, would certainly not be good, even if the NBER, the National Bureau of Economic Research, declares that this isn't a technical recession. So, yeah, it's the Fed's in a big bind here. I don't think they can afford to implement a long-term Fed call, because I don't think they can. I think doing so would result in pulverizing the real estate market, in essence. That would force them to re-implement the Fed put, basically.
Yeah, so let's talk about the rates. One thing that always puzzled me is that we hear all about the interest rate, especially in times like these, in the business news. And, we hear that the market has priced in 50, 75, or 100 basis points, whatever it might be. Where do we find that information? Where's that website that says the market has priced in 75 basis points? And what does it imply for investors whenever we hear things like that?
So the best place to always look is the 2-year treasury. That is reflective of the future expectations of Fed policy, in essence. So for instance, the 2-year peaked at like 3.4%. What was it, a month or two ago? We're at 2.9 right now. the Fed funds rate is only what? It's 2.3 or so. The effective Fed funds rate is 2.3 right now. So even though they've made it very clear they're going to raise rates to probably at least 3%, the 2-year treasury is priced that in. It was more aggressively priced even just a month or two ago. So that's usually the place to look, is the short end of the treasury curve usually front runs the Fed, and they try to get ahead of where the Fed is going to be. And so you can't just look at, like a lot of people, I see this on Twitter all the time, where people are like, oh, the rate of inflation is 8% and the Fed is only at 1%. And it's like, well, wait a minute, even a year ago, the 2-year treasury bill priced in way more than 1% Fed funds rate. So the Fed, and this is part of how Fed policy theoretically works. Well, not theoretically, this is how it really works, is that they tell the market where rates are going to go. And they're trying to, it's called open mouth policy, basically. They're communicating to the market, hey, we're going to do this. And, there's a lot of theory about how powerful this is, but it certainly, you see it reverberate through the actual bond markets, where the 2-year treasury will respond to these comments in a sort of hyperactive manner, where bond traders do reprice what the Fed does. And I always like to use the analogy of the Fed curve and the interest rate structure is a lot like a man walking a dog. And if you think of let's say the 2-year treasury is the dog, well, the Fed's holding the leash, but the Fed basically, when they say they're going to raise interest rates to like 3%, well, what they're really doing is they're letting the leash out a little bit. So they're letting the dog run out. The dog gets ahead. The dog front runs where the Fed is going to be in the future. And so even though the man might be holding this tight leash where, he's only allowing what looks like a 2% interest rate increase, the dog is already out there at 3%. And that's what you see in the 2-year. And so that's the best place to look when you're looking for, what are the market expectations. And it's actually one of the worrisome things right now, is that the 2-year is high relative to the 10-year. And so, people talk about this yield curve and the yield curve inversion. What the yield curve is basically saying right now is that the 10-year expectation of rates is lower than the 2-year expectation of rates, which is consistent with what we were just talking about, how, the risk of this policy mistake is being priced in, that the Fed, in the short term, they're going to go to 3%, but in the long run, are they going to end up having to retrace back to, 2.5 or 2%? And that's what the market is grappling with right now.
Cullen, as always, it's been fantastic speaking with you about inflation, this second part here, our inflation masterclass. Is there anything where you feel like we skipped over it? Anything you wanted to add to the conversation?
No, I feel like I talked so much. I talked too much. People are probably like, shut up.
Oh, I'm sure people are not like that at all, Cullen. It has been absolutely amazing, as always, speaking with you. I already look forward to the 10th time that we're going to bring you on. Cullen, where can the audience learn more about you, anything that you're up to?
So my main website is Pragmatic Capitalism. I started a YouTube channel recently called 3-Minute Money. If people want, they're sort of short, concise, educational, mostly videos on money and finance. You can keep an eye out for my new paper, the all duration paper. I think it's pretty cool. It's one of the first things I'm kind of excited about having written in a really long time. I haven't published a paper in, I don't know, 5 years. Not that that's something I try to do often or am proud about necessarily, but I think it's a cool sort of counterintuitive look at building out asset allocation models and a new framework for thinking about things across a very time-specific perspective of asset allocation that's very financial planning consistent. So I think it's cool. I think that people will like it, and keep an eye out for it. I'll publish it probably on SSRN and hopefully some journals, and certainly on PragCap. So.
Yeah, and we'll definitely make sure to link to it whenever it gets out. And most of our listeners are from the future, so whenever you're listening to this, make sure to check the show notes. You might see an outdated paper many years ago from Cullen now in the future about the current market conditions.
Yeah.
Cullen, as always, it's been a pleasure. Thank you so much for making time for the Investors Podcast. I can't wait to
Thank you
invite you
guys.
back on.
It's always great to talk to you guys.